We are continuing with 2020, grade 11, question 6.1.3. We suggest that the interest on capital of 12% per annum in the partnership agreement be reduced to 8% in line with current interest rates offered by commercial banks. How would this decision affect the partners if they had to share in a remaining loss? First of all, it would decrease partners' earnings. Secondly, it will decrease personal income. Which in turn will reduce personal income tax. (6.2) We need to complete the equity and liabilities part of the balance sheet. We have the following information appeared. We've got the capital, current accounts, tangible assets, fixed deposit, loan, trading stock, debtors, creditors, SARS, bank overdraft, petty cash, cash flow, provision for bad debts, pension fund, income received in advance. Out of all of these, before we can even start doing the adjustments, we can write the numbers as notes in the owner's equity and in the liabilities part. Let's take a look. We've got capital of Raymond, which is 1 million. And we've got Klaarbar capital of 850,000. Then thereafter, the current accounts. Raymond has got a debit account, which means it's a minus. And Klaarbar has got 51,800, a credit. So we have to subtract the 8,450 from for Raymond. The intangible assets we don't do, fixed deposit we don't do. Next part is the loan, which starts off at 200,000. Trading stock we don't, debtors control we don't. Creditors control, we start over here, 45,350. So to add, we've got the creditors control, which is the first one. Then we've got SARS, pay as you earn. So we add SARS, which is 17,500. We've got a bank overdraft of 101,250. And in this case, it is a liability and not an asset. After bank overdraft, no to petty cash, no to cash flow, doesn't go in here. Provision for bad debts doesn't go in here. Next one is our pension fund, which is 2,500. And then income received in advance, which is 3,500. That is all the values that we can add to the balance sheet, even though we haven't started doing any adjustments yet. Let's take a look at the adjustments. First one, check for 75,000, dated 31 March. In this case, it is a post-dated check, which means it will only come due after the financial year end. Was issued to Wiseman Builders for improvements to the property, was properly recorded in the CPJ and posted to the general ledger. Make the necessary adjustments in the balance sheet. If we take a look at our accounts, here we've got bank. Bank at this stage is a liability, which means we've got the plus on the credit side and the minus on the debit side. And we've got 101,250. We actually need to take out the 75,000 because it's not due at this particular stage. So we're going to debit or minus the 75,000 on the debit side, and we're going to take it to creditors because it's not due now. We still owe them that money. We still owe that 75,000 as creditors. Therefore, in our balance sheet, in the bank overdraft, we said we need to subtract the 75,000 and we have to add it to the creditors or the trade and other payables. We have to add 75,000. The second adjustment, 28 February, partner Klaba contributed equipment to the value of 150,000 to equalize his capital contribution. Therefore, in the capital, we have to add another 150,000. This entry was not recorded. So we would credit our capital and we would debit the equipment. Third one, partners have agreed to pay off 100,000 Rand of the loan from Ching Bank by the 30th of April 2015. This falls within the next 12 months from a long-term loan. So all that we need to do, this loan or this part of the loan has now become a current portion of the loan. So we have to add it there and we have to subtract it from the loan there. That's our adjustments. Now all that we need to do is to finish off the balance sheet. If we take a look, the 1 million plus the 850,000 plus the 150,000 gives us 2 million. Then our current accounts, we've got 51,800 minus 8,450 gives us 43,350. We can add up those two values as the partner's equity, so it's a 2 million plus 43,350 gives us 2,043,350. Non-current liabilities is only 100,000, which is the non-current liabilities add up to 100,000. And then for our current liabilities, we've got our bank overdraft, which is 101,250 minus 75,000 gives us 2,650. Then we've also got the trade and other payables. There we've got the following. We've got the 45,350, add to it 17,500, add to it 2,500, add to it 3,500, add to it 75,000, gives us 143,850. So that would give us 143,850. Lastly, current portion of the loan is 100,000. We can add up those three and write the answer into current liabilities. So we've got 26,250 plus 143,850 plus 100,000 gives us 270,000. 100. Then to get the final total, we have to take our partner's equity, we have to add our non-current liabilities, we have to add our current liabilities. If we add it, the 270,100 plus the 100,000 plus 2043,350 gives us 2,413,450. Please note with the memo, I added a value there in front, which is incorrect. This concludes the balance sheet part of the question.